Hi there, and welcome to another episode of The People of Private Capital. In this episode, I'll be speaking with Julian Schickel. Julian is co-founder and managing partner at Avellinia Capital, a European credit fund. They're a very valued client of asset class. I'm delighted to be able to speak with Julian about the history of the firm, how it was initially conceived, how it has progressed in recent years as they move from their existing fund into a new fundraising cycle. We talk about some of the challenges facing the credit sector and, of course, some of the opportunities. So let's dive in. Enjoy the episode here on The People of Private Capital. Well, good morning, Julian. Really appreciate you taking time to join us here on the podcast. Thanks very much for participating.
Hi, Freddie. Thanks for having me. It's a
Yep.
great pleasure to be here.
Yeah, great. And so, Julian, as I mentioned, when we were talking about the podcast earlier, one of the key things that we're keen that people get out, our audience get out of the podcast is an understanding of the people in private capital. And I thought it'd be great, just by way of background, I should disclose that you're a client of ours, and we're delighted to have you, very proud to have you as a client. But for people who don't know Julian, can you give us a little bit of background as to who you are, how you progressed throughout your career to get to Avellinia?
Absolutely. And let me first say we're a happy client. So again, thanks for having me and thanks for supporting our team over the past years.
It's great to hear.
Always work in progress, but you've done a great job in expanding your team and
Thanks very much.
focusing on your clients, which is what we're trying to do as well. Maybe a few words on myself. I'm born and raised in Hamburg. Maybe some of you will detect some strange accent, which has morphed a little bit over time. Hamburg, Germany, left there right after high school, basically through some various traditional German universities in economics and business. I finally arrived in a more international setting and did a master's degree across 3 countries, Paris, Oxford, Berlin at the time, which I enjoyed and which I think gave me a great head start in understanding how people from different cultural backgrounds take how to work together with them in groups, which obviously then became even more important in my first job. I started after being a good German of that generation. I did a lot of internships, probably a few too many. The one thing I didn't want to do was join a bank because I'd done a few banking internships and really hadn't liked that. As these things are, and given I was self-financing my studies, what was the thing when I was in Oxford that helped me finance my studies? Of course, an internship at an investment bank, Credit Suisse back in the day. I
Right.
kind of hated that as well, but I made good money and I learned a lot. So I said, why not try out something else over the summer? That was Lehman Brothers then, going from the, as they called it back then, one-stop shop bank to the specialist investment bank, one of the last remaining pure breeds at the time. And
Right.
fast forward a year, I had the opportunity. I was invited back to join as a senior analyst there. Spent my first formative 6 years or so, 5.5, I think, at Lehman in what was then still a new thing, structured credit, or the structured credit products group. So I think
Right.
the 3-letter acronyms that then blew up the world, the financial world as we knew it: ABS, CLO, CDO, and
Yeah.
some even more exotic constructs. Again, great learning curve, fantastic people, actually a fantastic firm. The end was obviously less fantastic.
Yeah.
Having said that, the one big advantage which I quickly realized shortly thereafter was that suddenly my network, which you take decades to build, suddenly was dispersed all over the financial world, which was fantastic. My
Yeah.
ex-colleagues back at other banks on the buy side elsewhere. So that it wasn't all bad. It was actually pretty good start.
Silver lining. Yeah.
I then joined Glencore. I didn't want to join the next worst bank. Had the opportunity to switch asset classes and roles and joined Glencore in Switzerland in commodities trading. So slight detour, a slight step to the side. Initially I couldn't figure out why they actually hired me, and then it didn't take me too long to understand that especially physical commodities trading, of course, has a lot of structured finance elements on the asset finance and the trade finance side. So that, if you want, was my first foray into private capital or private
Right.
financing, because we were no longer dealing with or hardly dealing with publicly listed securities anymore, but obviously
And
private finance.
that was coal trading. Is that right?
That is right. Yes, I'm
Yeah.
still paying penance for my
Yeah.
sins.
Right. Very good. And so you were there until kind of the 2008 type period,
Yeah,
right?
I was there from beginning of '09 until late 2010, so not that long. It
Okay.
was an interesting time because the company was preparing for its IPO, and I'll spare everybody the details, but there was a bit of inward focus, and I had the opportunity in late 2010 to join some former colleagues who had previously tried to hire me a couple of times already, to move to the buy side. So ex-Lehman colleagues who were at a structured credit hedge fund, or today we would say the company has morphed into more of an alternative credit manager these
Right.
days, Zeiss Group. I was there back to London. I was at Zeiss for, I think, 6.5 years, and working on all things asset-backed again, and then also for the last 2 or 3 years leading the EMEA business there, which was my first, if you want, small leadership position.
Right. Right. And that kind of precipitated Avellinia. So that was kind of your last position
That was
prior to it.
my last proper job, as I
Right.
sometimes um, you know have difficulties admitting to myself, and that's now a while ago. In the last year or two there, we had witnessed already the advent of private credit and direct lending. This huge wave coming from the U.S. and finally arriving in Europe, and we to a degree maybe we felt a little bit left out, and then we also at the same time saw that fintech lending was becoming a thing. The data availability technology made it possible to underwrite credit and small ticket credit much more efficiently. And putting one and one together, our thesis was what has happened on the direct lending side, on the private credit side in direct lending, could potentially or would probably happen also on what I refer to as the portfolio credit side, as
Yep.
in portfolios of credit, loans, receivables, etc. And
Yep.
that's what I pitched to my partners in the US at the time. And there are many reasons for it. They were less keen to do that in Europe. We worked on a few potential partnerships and joint ventures and getting something done in that space. Ultimately ended up not doing that. And then fast forward, I did a bit of advisory work for a few companies thereafter, and worked on the thesis, found the right partners, got together with my co-founder, and we ultimately then started Avellinia, which, and we can dive into that a bit more later, was probably a product of excitement, optimism, and a bit of maybe a bit too much of naivete as well. Starting a personal, small, 250,000 euro investment between my co-founder, myself, and a friend.
Yeah. Right. And I mean, it's been phenomenal growth, I guess, since so founded around 2017, correct? Is that right?
Yeah, it depends a little bit on how you look at it.
Mm.
Institutional, fully scalable. We raised our first institutional funds in 2022. We started
Mhm.
investing for institutional investors in 2020, 21. And
Yeah.
a couple of years before that, we were all still in other jobs or finishing other projects. My co-founder was an entrepreneur already on the real estate side, and we were kind of morphing into that. So we've all been at it full time since, I think, 21,
Yeah.
late 21, and then raised our first institutional fund about a year later.
Yeah. And what was the primary thesis, Julian? Where did you want to focus? It's obviously a pretty broad market in terms of potential opportunity. Um,
Yeah,
what were you thinking when you?
it goes back to this, I suppose, fascination of seeing that there's this financing gap on the one hand, just generically in SME and also consumer credit, where it's easy to get, if you're an entrepreneur, relatively speaking, easy to get your first couple of millions from your local savings banks,
Mhm.
or some other relationship you may have. Then one of our potential borrowers has referred to that as the death valley of lending. Then there is this gap where nobody's going to lend to you. JP Morgan, no, you're too small. Your local
Yeah.
savings bank, you're getting a little bit of a large exposure, and there's a lot of risk attached to your business. So, and that is generic. It has nothing to do with structured credit or asset-based finance, what we do now. But it's also true, especially true in our niche.
Hmm.
Um, the other bit of the fascination, or if you want the thesis here, was, again, we had seen this shift from public market credit to private market credit, first in the US, and then on the single name credit side, also in Europe. And we were expecting to see a similar development in all things asset backed.
Yeah.
add a macro trend I think we're all aware of. That's probably less of a generational thing now, but it started as such. There's a trend from having to own things to being willing to and able to, based on technology, use rent assets, lease assets, even
Yep.
pay-per-use for machinery is a concept that exists now, and some
Mhm.
companies successfully run. So all of these trends, and if you then add the question of dilution and equity versus debt financing, there was something there. And we had obviously seen, we were not the first ones, you're never the first one, but we've seen some US, both buy side and sell side firms very successfully focusing on this niche and on the more data driven models. Silicon Valley Bank, now in Europe, HSBC Innovation Bank, were at the forefront of this. They were financing a lot of these early or relatively early stage businesses. On
Yeah.
the larger end of the private side spectrum, you had, or you still have, firms like Avellinia, Victory Park, which we still look up to, and we're
Mhm.
fascinated by what they had built. And then last but not least, you have some, of course, some peers in Europe, peers of ours, competitors, if you want, who started earlier than we did and built successful businesses, be that Fasanara, be that BCI in the UK, and some
Yep.
others. So we thought there was still a niche that was, relatively speaking, not penetrated, where there was room for developing lending solutions, creative solutions for businesses that need capital to scale their asset portfolios without too much dilution.
Mhm. And if we look at kind of the profile of opportunity that you pursue, can you talk about some of the deals that you've worked on, and what the purpose, I guess, of that debt facility was?
Absolutely. So I think it always starts with, obviously, let me start that again.
Yep.
Hmm.
So Des just edit that. Yep.
Yeah. So we've looked at many things, from more classic loan and receivable portfolios, factoring, invoice financing across industries, to, on the other end of the spectrum, more esoteric assets such as YouTube receivables or royalties, if you want to call them that.
Right.
So we're one step further from music royalties. Our bread and butter are receivables and loans, leasing receivables in some cases, in many cases, very short-term working capital receivables. So think invoice financing, factoring, etc.
Yep.
However, less on the traditional side, we finance some of those books as well, and more on the more innovative side. Our focus is always on the what we call the innovation economy. So companies, typically startups, scale-ups, growth companies that use an innovative approach to of originating these assets and risk managing them. And as I said earlier, only technology and data availability has made it possible for some of these products to actually thrive in the market. It's just not efficient if you have a person at a bank going through documents, paper documents, think 10 years ago, to underwrite a loan that is 5K. That's
Yep.
absurd. If you can
Mhm.
do that largely or fully automated, it becomes a scalable business, assuming that you have your risk under control. So if you want, to a degree, we obviously underwrite the assets and the portfolio, and then to another degree, we underwrite the underwriter and set certain rules or frameworks within they then are allowed, if you want, to use our facility and originate additional assets.
Yeah.
So for what we've done, concretely speaking, let me give you a couple of examples from recent days. We finance part of a camper van portfolio, so camper van rental. That is a
Yep.
thing. You may have seen some of those very well branded vans driving around the streets wherever you are. They're present in, I think, 15 markets right now across Europe and North America. To stay with uh, the mobility topic, we finance or finance a part of the book of a car subscription company. What is car subscription? Short-term car leasing, fully digital. You choose your car online. A couple of weeks later, typically, you get it delivered to your doorstep. Everything included: road tax, insurance, except
Yep.
fuel or electric charges. Importantly, these type of assets you can finance relatively easily through banks and much cheaper and efficient bank financing. However, there's always a leftover of the collateral pool, be that obviously on the junior side. So in that case, we provide junior financing, or in some cases, excess concentrations or certain things, think new market entries, things that don't fit the collateral pool and the risk appetite of a bank. So that's where we would play.
Right. And
Other
do
things
you
we've
part?
done is
Oh, sorry.
give you one
Sorry. Go
more
ahead.
example. Give you one
Yep.
more example, if I may. We were recently refinanced in this, but we for a while financed an IVF financing originator. What does that mean? A company that lends to people who are looking for basically a fertility treatment. So
Yep.
all of these more exotic and niche solutions that are not yet scaled and about to scale, we try to work with to get them to a point, assuming it's a fit for everybody, where they can actually then be refinanced by a large bank. And we've had access to JP Morgan, to NatWest, to some large banks and large funds as well.
Yeah. So you're coming in on let's say the capital stack, wherever you sit in the senior or junior kind of debt. Are you typically coming in with other partners to provide those solutions, or are
So
you a potential
very
kind of
good
single
question.
source?
It's a very good question. So first of all, we do act across the capital structure. So from
Hmm.
typically early stage stretched senior, first institutional money to these
Yep.
portfolios, down to, in some cases, what you would classify as first loss capital. So mezzanine, first loss, mezzanine, and stretched senior. That entirely depends on what the asset pool is, how late stage or early stage the originator, the track record, the portfolio is, what size it is. So we will make that determination. In
Hmm.
terms of partnerships, we are open to working with partners. I think one of the earlier lessons learned was, and that was when we had very small amounts of capital to invest, so we almost had to partner with others. We want to, wherever we can, be in control and need to be in control. These are
Yeah.
complex finances, and when things go wrong, you want to be able to call the shots.
Yeah.
That there are always situations where it makes sense to partner, and you by definition you partner if you're mezzanine, if you're junior in the capital structure, you by definition partner with a senior lender or vice versa. So, but that is a
Yep.
different partnership to co-investing in the same part of the capital structure with somebody else.
Yeah. Yeah. And looking at the LP side, the investor side of your fund, who you typically appealing to as a potential LP in your fund?
Well, given we are about to go fundraising again after a bit of a break, that's a very good question, and we're trying to figure that out. Now,
Mhm.
jokes aside, we were lucky enough to early on attract the interest, and also then received an investment from some institutional investors across a bank, several insurance companies, fund of funds. So
Mhm.
it's that whole gamut. We co-invested early on with a large foundation. Of course, we work with family offices and multifamily offices. Even though I have to admit we should probably do more work on that side. So we are open. The question is who is willing and interested to partner with us.
Yeah.
It was a complex niche. This is not for everybody.
Mhm.
We firmly believe and take the view that these are extremely interesting risk-adjusted returns, which are driven mainly, there's no magic to it. It's complexity, it's illiquidity, so the proverbial liquidity complexity premium, if you want to call it that.
Yep.
And given the complexity, especially on the smaller end of the spectrum, and if you want to take the reference from another now established market, direct lending, people refer to the lower mid market.
Yep.
This is not commonly used in the asset-based lending space, but basically what we do is the lower mid market lending here. We're
Yeah.
focused on 5 to 50 million type portfolios, not the 200 million portfolios where banks can just much more efficiently deliver at a lower price. But
Yeah.
we deliver that early stage, higher risk capital with a more complex structure to mitigate risks.
Yeah. And are LPs coming into the fund for a fixed term? Um, what's the kind of high level proposition?
So we try to be as open and creative as we are on the asset side, also when it comes to the funding side.
Hmm.
Meaning, while a commingled discretionary fund, which we first one we raised 3 years ago, 3.5 years ago now, is of course extremely valuable for any buy side firm.
Hmm.
We we've by now expanded that capital into all sorts of separately managed account co-investment mandates, either one-offs or more programmatic, and at this point, I think our ratio is probably 4 times on that side versus 1 time on the fully discretionary side, which is something that is not, I would say, atypical for credit funds. So it's something we were always conscious of and aware of. And, if you think about it conceptually, we anchor a trade, we get comfortable with it, we underwrite it, we make a first investment, that trade is successful and grows, it'll quickly grow out of our capacity. So that's when we need partners if we want to stay in control. And we've monetized that, we've leveraged that, and we've opened that up to some of our LPs, but also other external investors, and continue to do so.
Yeah.
And there are all things in the middle.
Yeah. One of the things that fascinates me about credit funds is the due diligence process. When you're evaluating the risk, can you talk a little bit about what that looks like for you? Typically, I mean, you're dealing, as you say, with the kind of lower mid market. How intimately are you getting into the operations of that business to understand clearly the financials, but also the kind of operating practices, what degree of risk you may be exposed to? What does that look like for you?
It's a good question, and I've mentioned the term complexity a few times now, and I would say when it comes to underwriting, when it comes to understanding and analyzing risk, there is, again, this is a term that is extremely important. It is highly complex, and it is multidimensional. If you ask some of our existing borrowers or prospective borrowers, clients, whatever you want to refer to, some of them will probably say that was a painful process. And this is probably true because we feel that we have to deep dive and turn over every stone that we can possibly see. The reality here is we're underwriting several things. We're underwriting credit assets. That's our first and foremost focus. But we're also underwriting a team, a business, their ability to scale, but first and foremost to maintain that risk, i.e., yes, will we look at the policies, will we look at the underwriting approach, the framework? Absolutely, in detail. However, what we have often found in early stage companies is some may deviate from that, and you may not always be aware of that, even if the documentation says something else. So it is building that rapport, understanding if the people in charge who are building that business or have already built it are willing and able to commit to really open the kimono and to show you what is going on under the hood, and if they're also committed to showing you what is changing over time. And that requires, this is not all, you can never document that fully, i.e., you need to have that dialogue, and typically we have a weekly or bi-monthly call with all of our portfolio companies. If things get complicated, it can be daily. So we're trying to stay quite close to the action. And of course, there's the traditional initial screening, data analysis, track record analysis, looking at their systems, their operations, doing on-site diligence, all of that. Absolutely. But almost the more important is the ongoing monitoring beyond just looking at the numbers and the reporting, and having that dialogue, diving into, what happened with that borrower? Why have you focused on this sector ABC recently? There was a little hiccup there. Any lessons learned? Can we share our experience? What is going on the system side, etc. So if you want to separate it, and this is where we're somewhat at the intersection of, if you want, venture capital, private credit, asset-based lending. If you go one step back, you have the qualitative side. That's what I just talked about a bit. You have the quantitative side. Again, I mentioned some of that. Of course, there's a lot of data analysis going on in the background. We build our proprietary systems, and are still also always trying to make sense of any number that we get out of the company. But as more we can automate on our end, the better our understanding for the underlying portfolio will be.
Yeah. It's super interesting. I mean, as you're describing it there, it does sound like almost like a PE investment in a growth stage firm, which I guess there's a lot of characteristics that would be similar to those firms that you're lending to.
It's when I talk about it, it sounds more like an art than a science. The reality is it's a highly structured process. We establish, and it's a step process. Importantly, I think you're right. it is a combination of a more venture or PE style underwriting approach in combination with the credit and underwriting approach, and that informs the structuring of the transaction and future decision making.
Yep.
Our transactions tend to be quite covenant heavy, and the reason for that is things change. We need early warning signs. We prefer to have the right and the requirement to sit at a table when something doesn't exactly go to plan, and then figure out how to take it from there. We don't set these tight covenants to have somebody in breach declare an event of default and enforce. That's absolutely not in our interest. Of course, we will do that if we have to.
Yep.
But the point there is you need to be in control. These are early stage businesses. They're early stage portfolios. A lot can go wrong, and you need to have a close handle on that risk.
Yeah. Yeah. Yeah, that's super interesting. Just zooming out a little bit, Julian, it feels to me like the last 2 or 3 years in the private credit space, the demise of private credit is being predicted because it kind of grew so quickly. There was a lot of opportunity, but I still see great growth in the sector, and companies doing really well. Funds doing really well. I'm just interested from your perspective. Clearly, there are a lot of contributing factors as to why private credit has experienced the kind of growth that it's seen in recent years in particular. What do you see as kind of the positive tailwinds for this market that you have benefited from, and perhaps other credit funds have benefited from?
That's a good question. I think there are at least three big trends driving our space. And when I say our space, that's private credit, but specifically, of course, also asset-based finance, which is where we are focused. First, institutional investors are still allocating more to private credit overall. And yes, there are certain geographies where that may no longer be the case in certain sectors. But if we think about it, we've been focused on Europe to this point. Europe being the UK, continental Europe, and adjacent countries. In most of these countries, institutional investors they have been allocating to credit, private credit, and most of them are still increasing those allocations. Now, on the direct lending side, some may be heavily over allocated at this point. True. On the real estate side, that may have been the case, may have eased. There's maybe a bit more opportunity. Infrastructure is booming. Asset-based finance, 2 or 3 years ago, our biggest challenge was that investors didn't know what we were speaking about. They didn't understand what strange thing we were trying to sell them. This has changed by some of our peers, some of our larger competitors, also on the very large end of the spectrum, the KKRs of this world, very active in this space, etc. They have done the rounds. They have raised significant capital, but this is still a niche. In our sort of mid-market sector or segment of this market, there is still not a lot has been allocated. There are a few, 3, 4 years ago, there were 5 peers or competitors in Europe. Maybe this is now 12 or 15, but the market has grown much more significantly than the number of or ability of our competitors. So in other words, I think we're all in a pretty good space here. There's a lot to be done. We're just at the beginning of this trend. Secondly, I think it was the big macro shift, and I mentioned it briefly earlier, ongoing from asset ownership to rental, and that's classic leasing models, pay-per-use models, and fascinating by some leasing companies that are offering machinery to SMEs and larger companies that are financing pay-per-use. This, for example, I think that the much here is also take the one that we talked about earlier, small ticket lending, and also intangible assets like IP, royalties, etc. All of these can now be financed in ways that these could not be financed a decade ago, or even in some cases 5 years ago.
Yeah. What's the most interesting thing that you've maybe not financed, or maybe you have, that perhaps might not be one of the, we've seen these models emerge, the back catalogs and recording rights, and anything that the finance whizzes can think of are being put out there to the market. What's anything that you've looked at at Avellinia or even prior to that that was interesting to you or that sticks in your mind?
Yeah, I think I mentioned a few. To mention some others, I think what is recently interesting are some models focused on on the energy sector.
Mhm.
Some may have wrongfully put that in the the green bucket or the ESG bucket, which may or may not be popular in certain parts of this world at this
Yep.
point. But the point is, there is an energy transition ongoing, and there are huge asset investments to be financed. If that is solar, if that is wind, if that is other stuff, nuclear, there is a lot to be financed, and some of this financing, significant amounts of this financing will come, especially for the more innovative solutions, will come from the private side. If you then combine that, and I can give you a concrete example or a few, with something that's a bit different, a bit more quirky, that's probably where we are most interested, because not everybody is looking at that. It's too small, maybe not as scalable. Recently, we
Yep.
looked at a data center, AI obviously being a huge topic that everybody talks about these days. We all know data centers are being built, need to be built. How do you solve for the energy consumption of these data centers? Some concepts we've recently come across. There's a startup that is building its first data center, or starting to build that, right next to a basically a wind power generation, existing
Right.
power generation.
Existing source of energy. Yeah.
Exactly.
Wow.
You think a step further, there are now, we've seen what happened in Spain and Portugal earlier this year with electricity suddenly dropping and the grids not being able to handle the capacity anymore. So what that points to is battery storage, right? So
Hmm.
combine wind or solar with battery storage, and again, something that a lot of startups and scale-ups have been working on, but there's not yet that commoditized space that every bank just funds these assets at 3.5%.
Yeah. Yeah.
Um, we've seen interesting things I mentioned YouTube, the influencer space. I mentioned in vitro fertilization. So again, all not necessarily revolutionary, but evolutionary, interesting takes on specific niches.
Yeah. Yeah. I was speaking recently with founder of a private equity firm in the US. They're focused on the lower mid market, and they've invested in a pretty wide range of companies. Pretty varied, let's say. So some are kind of in the forklift sector, others are in the pet food sector, and I asked him, what the investment thesis was for investing in such a wide variety of businesses. And he said, well, actually, when you look at the books, they all look very similar. And he was interested in that as a principle. His background was in what was it? What was actually he started out as an accountant and kind of moved through as a CPA in the US, and so he had a very structured means of assessing the books and records of each business that he invested in, and that was the common thread. Do you have a similar kind of thesis, or because you are looking at a very broad spectrum there, but you're looking for fundamentals, I'm assuming.
Yes, yes, absolutely. And I would tend to agree. I think the challenge is always to structure a transaction that works for your unique case with the unique challenges that that specific underlying collateral or asset and company and market or business
Hmm.
model may have. However, the mechanics, you know, we didn't invent these mechanics. These are structured finance 101. And yes, if you do a deep dive, your specialization course in your master's degree is probably where you would maybe see some of that stuff, but it's not rocket science. The
Hmm.
rocket science here is more done on the side of the innovative entrepreneurs that work with, as I mentioned earlier, of course, use AI, use data tools and other technology that allow this kind of lending and origination of these assets, which was just not possible before. We
Yeah.
then apply a little bit of our secret sauce as well, in terms of, again, the underwriting machine and our proprietary systems. But it is there are recurring topics. The structures are more or less similar, or at least structural elements we will reuse and adjust for different use cases. And ultimately, a founder's journey also has similar aspects, uh, from start to success or to failure. So I
Hmm.
think if anything, you learn over time how to scale certain business models, and we can hopefully also add some value, in some cases assisting founder teams or teams that are growing these businesses with some best practice or things we have learned over time, especially of course when it comes to all things credit. But you see repeating patterns. We look at probably 250, 300 cases a year. We finance 5 of them, but there's a learning from 250 of these cases.
Yeah.
Not all of them we do a deep dive on, but you start to understand how to compare, apples and pears, maybe not bananas. If that
Yeah.
makes sense.
Yeah. Yeah. Absolutely. Yeah. No, that's great insight. And kind of
Hey, if I may interrupt there for a second, in the end, we're looking at a contractual cash flow stream that we can underwrite, right? And if this cash flow stream comes from cars, from leasing agreements, from consumer loans, that's a secondary thought. And of course, there are different dynamics. There are different, risk profiles. There are also different regulatory aspects to consider. But ultimately, we look at a stream of cash flows that are contractual and what you lend against that.
yeah. Yeah. Very good. Looking on the flip side, Julian, are there any trends that are kind of worrying for you right now, or things that you feel you've got to put some thought around how to mitigate in the private credit markets today?
I think some sectors are getting a little frothy. Again,
Hmm.
as soon as something works well, some people in the market and some journalists will say this is the end of it, and
Yeah.
it's gone beyond its peak. I'm not at that point. I've gone through 2008 and some other crises. I've seen 2006 and 7 in the boom years, and I've seen the dot-com bubble before that, and obviously also some recent bubbles.
Yeah.
Or what we don't know yet if they're bubbles or not. I think Warren Buffett said at some point, bubbles are great as long as you know when to get out before that whole thing explodes. But it's important to understand we're not trying to time market here. We're not trading. These are long-term investments. So, and we're credit investors. We have an asymmetric downside profile here or upside profile, right? We can lose our shirt, but we have a contractually limited upside in
Yeah.
form of coupon. And yes, there may be in some cases some other upside which improves that profile a little bit. But ultimately, as much as I'm an entrepreneur myself and looking at the glass half full as a credit investor, I also need to look at it as half empty. So I think what I've always liked at credit is you try to focus on it from the different perspectives, and we're closer to the equity story also when it comes to the assets. So we need to understand the glass half full, but also the glass half empty.
Yeah.
When it comes to go back to your question, where am I concerned? I'm concerned about complacency. I'm always concerned when I see people not doing the job they're supposed to be doing. I'm not going to point fingers, but it was somewhat concerning to us when we heard from some of our borrowers that we did, that our process, got the question, why is your process so onerous? We got money from XYZ and this other institution, maybe on the equity side, maybe in some cases on the credit side, they didn't ask these questions. And, when equity investors specifically stop asking some questions because there's such a boom going on, or maybe just take the portfolio approach, which is fair, but that's when I get a little concerned because I tend to sit higher than them in the capital structure, and I tend to get my money back before they do. So
Yeah.
these are red flags to us. Now we've seen that correct. We've seen VC PE doing phenomenal work, going very deep, and we partner with a lot of these companies. But when we see these isolated examples, that's always a source of concern. We
Yeah.
also are concerned more at a micro level when we see things happening in a portfolio that are, somebody tries to explain away, but the data shows something else, which goes back to the hard facts rather than the science rather than the art. So that's when we start
Yeah.
digging. I think we're always keeping our eyes open to, is something off here? Does something smell? Does something not look right? And what is the projected trend from here?
Yeah. Yeah. No, very good. Yeah, that diligence. I mean, certainly the firms that we work with, and we obviously get into the detail of the diligence process with a number of our clients. Um, Super important, and arguably more important when the market is super frothy, because there's so much hype around, the potential that you feel, oh, well, it's a competitive situation. You've got to move quickly, et cetera. It's a real trap for, for some of these firms, I can see.
What does worry me on a macro level, we're in a time of very heightened uncertainty geopolitically that has impacts. And I'm not going to start a discussion with you on some of the more concrete examples, but clearly markets are, we're seeing historical highs again in public markets frequently, and this decoupling has happened very
Yeah.
obviously, while we have the potential for very high volatility. And now we are sitting somewhat on the sidelines of that because we're not trading, we're not participating in these markets, but of course they impact our market as well. So we are
Hmm.
watching these market trends very carefully and do have some concerns. It's not a one-way street.
Yeah. Yeah.
Obviously, when it then comes to translating this into macro, and if I look at more concretely at default rates, we do expect default rates to increase. We've seen it in a few European countries where we are focused. Overall, risk is not out of control. The interesting bit is our capital is quite expensive. Our niche solutions are quite focused. So I would say the best market for us is a difficult market with some volatility where financing is not abundant. So when it gets a little more, more difficult and default rates go up a bit, that's better for us than walls of capital, not looking at the details and just flooding the market. Germany is a great example, a market that, France as well, markets that have been historically over the past decades overbanked, if anything. That has changed a little bit, not dramatically, but a little bit. You see weaker borrowers, but you also see banks finally retracting a bit. And what that means is that a market comes back to what we think is a more adequate pricing level, which is why we've done more in these markets more recently, being very aware of those risks. Before we were
Mhm.
almost excluded because of essentially what we believe are nonsensical underwriting and pricing levels.
Yeah.
Now, when that goes too far, stating the obvious, that's then a problem at some point.
Hmm. Yep. Yeah.
We're far from
Absolutely.
that.
Yeah. Looking kind of a little bit longer term then, Julian, when you look at Avellinia, you're as you say, you're about to start fundraising again. A couple of questions around that. One, what are your thoughts on the fundraising environment today? And then kind of looking longer term, what are your aspirations for Avellinia as a firm?
So in terms of fundraising, it's going to be interesting to see. The market was entirely shut about a year ago, or until about a year ago. We then
Hmm.
saw some first green shoots, I would say. And I think the fundraising market remains difficult in specific sectors. Private equity has had a hard time. Venture capital wasn't easy, but then you still see some very large and very interesting raises. So the market is open. It's probably more discerning. So ultimately, it goes back to we need to deliver, and we need to be able to show that we can deliver, show our track record, show how we manage risk, how we manage and structure transactions. And with that, I'm quite optimistic that we will find, our new flock and some of hopefully some of our existing investors that will re-up as well.
Yeah.
It's not easy, but frankly speaking, this shouldn't be easy because people are entrusting us with their money, and we're not a major global institution where that is very easy to do. People do
Hmm.
have not only the risk of losing money, they also have reputation risk. It goes back to large institutional investors sometimes preferring large names because if something goes wrong there, it's easier to say, this went wrong, but it was BlackRock, than to say this went wrong, but I made the decision to allocate with Avellinia. Who's Avellinia? Right.
Yeah.
So,
Yep.
and that leads me, I guess, to the next topic, long-term aspirations. I think we're far from present as thought leaders, and I also don't want to be the 1,000th person on LinkedIn, uh, you know, posting AI-generated content. But I
Yep.
think building rapport with your core stakeholders, and expanding that network, building trust, and giving people reasons to maintain that trust and ultimately grow with you is what we have been focused on and want to be focused on. I don't see the sky's the limit. I don't see a reason for why our growth should be stopping. In fact, it's been accelerating over the past 12 months. We're finally, as I say it, and I'm always a bit impatient, we're finally getting somewhere. So really what we want to do is we want to provide to our borrowers capital solutions that solve their issues, that address their needs, and that are priced in a way that they're palatable and make sense to them. There is a bit of competition, but ultimately we've always been able to win those transactions if we were able to add that little bit of extra value. And that is usually, in our case, has not been pricing. We sometimes have been more expensive than others, but we're still able to convince borrowers to work with us because we, I think, hopefully brought across how we can add value also in an intangible way. The same or similar applies on the investor side. If we're able to deliver consistent returns and are transparent in our communication about issues, about risks we take and how we mitigate those risks, it's a pyramid. You build one stone on another, and ultimately, one later than the next, people start trusting you, and they will ultimately allocate money to you. This is a long haul game. This is not a sprint. This is a marathon, probably a few marathons. If you think about also expanding from one core strategy, structured credit, structured finance, private credit is a vast field. We're tackling a very small niche even within asset-based finance. My co-founder likes saying, KKR finances airplanes, we finance iPhones. And there's a lot of truth in that, but there's nothing to say that we couldn't also finance other assets. There's nothing to say that we couldn't focus on more opportunistic strategies, which I've done in my past. Co-founder has too. So there's a lot to be done. I think when it comes to building a business, and this is probably something we've learned from some of our portfolio companies and founding teams, some very impressive people. It is about doing one thing right at a time and not trying to be everything to everybody at the same time. And I think as long as we're disciplined in delivering on one thing, and once we have delivered there, we can think about the next thing that has served us well, and I hope it will continue to serve us well. Our next concrete steps, we need to expand the team. We are looking to launch our next fund. We are nowhere when it comes to North America. So that is, for me, that's a big 2026 topic. How do we address North America when it comes to both the investing and investor side and fundraising?
Well, exciting times ahead, Julian. I know we've certainly seen vastly improved conditions on the fundraising side. I'm in the US at the moment, and lots of activity here. A lot of our existing clients now moving into fundraising mode. So I think that the markets are certainly better for that now than they would have been over certainly the last 18 months or so. It's been challenging. But I wish you every success with that.
Thank you.
For people who want to learn more about Avellinia or get in contact with you, Julian, are you active on social? Where can they connect with you?
Yeah, relatively speaking, I'm on LinkedIn. You'll also find our contact data on our website. That's www.avellinia.com, and that's AVELLINIA.com. And one thing I learned is next time we probably choose an easier name, but we liked it.
Yes, the benefit that it stands out, but is it 2 L's, 2 N's?
Exactly.
That's great. Well, we'll put a link to the website and to your LinkedIn profile in the show notes as well. Julian, for the People of Private Capital podcast, I really appreciate you taking your time out. I appreciate your business as a client of ours, and hope that we can help you in this next phase. It's an exciting time ahead for yourself and Matthias and the rest of the team there. So the very best of luck with that. But for today, thanks very much for joining us, Julian.
Thanks very much, Ferdy. Much appreciated. And I think there's some listening to be done on my end. I'm sure there are some other interesting conversations you've had. I've had a lot of fun today. Enjoyed the conversation. Thanks for the time.
Thanks, Julian. Appreciate it.